If you believed the media, you'd think that all property investors are ugly and greedy. There seems to be a disconnect between what the myth of property investment is and the reality when it comes down to even how many properties the average Australian investor owns. As I said, we hear about greedy landlords who own dozens of properties taking advantage of tenants pushing up their rents at the moment. But this isn't borne out by the facts. I guess you've heard me say before that around 70% of the 2.3 million property investors in Australia just own one property. In fact, 92% of all investors own only one or two properties. And that's despite the property boom that we've recently had. I guess what I'm suggesting is if you want to become financially successful through property, you're going to have to do things differently to what others do. And that's what I'm going to be discussing today with Brett Warren, National Director of Metropole, as we discuss some of the reasons most property investors fail to build a multi-million-dollar property portfolio. We're also going to talk about avoiding all the media hype, because despite the negative media coverages, our property markets have remained one of the best places in the world to invest in real estate. The property market's now bottomed out and we've got an upswing driven by supply and demand dynamics. Despite that, some people are still predicting property Armageddon. But I guess people have been predicting the end of the world since, the beginning of the world. It's only human nature to fear the unknown, and the media knows that and it plays on it. So today we're going to discuss a bit about what to listen to, who to listen to, and who to avoid. And as I said, how to avoid the common reasons most property investors fail to build a multi-million-dollar property portfolio. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Well, the property markets have turned, and despite rising interest rates and all the headwinds, it's clear that the property cycle has moved on and we're now at the beginning of the upturn stage of the property cycle. But if history repeats itself, and it most likely will, most of those who get into property investment aren't going to enjoy the success they're hoping for. So to help you take advantage of the new stage of the cycle, and I guess just as importantly, not to make some of the mistakes others have made in previous cycle, today I want to have a chat with Brett Warren, National Director of Metropole Property Strategists, so that we can have a talk about what's ahead and what you should do about it. Hi, Brett.
Hi, Michael. Good to be with you. And look, certainly, obviously going by the data and the statistics, that the market certainly has turned the corner. I know a lot of economists and commentators predicted that would happen this year, but gee whiz, you wouldn't know about it looking at the media, would you? There's certainly still a lot of fear-mongering. I think there's another cliff coming and the usual suspects are out for doom and gloom.
You're right, Brett, and I'm sure that's putting off a lot of people. People are still sitting on the sidelines and they're not going to get into the market until they recognise that the property market's been booming for a while. People have made money, auction clearance rates are high. The problem is that they've missed the bottom already, and those who are taking advantage of the current markets are going to be sitting back looking pretty. But I guess people have been predicting the end of the world since the beginning of the world. It's human nature, it's human tendency to fear the unknown. But Brett, the media knows it, doesn't it?
Well, look, absolutely. Look, they have to. I mean, that's the way they sell clicks and revenue and all the rest of it. But Michael, I guess you've been through this a lot more than I have, and I've certainly seen it a number of times. Should we be scared of the headlines?
Well, you're right. The media knows that fear sells. It generates clicks. It generates ad revenue. So we've got to remember that the media's job isn't to educate you. It's our job to educate ourselves. And I see you and I educating our clients at Metropole as well. So it's our job to help educate people. You've got to be careful who you listen to. I don't think you should dismiss the media entirely. Of course, there are times when the media is right to be negative, when there are real problems, when it's important to be informed. But it's also to remember the media, it's a business. they're not always telling the whole story. So it's crucial to differentiate between the noise and the signal. And look, you and I have often talked about it. Property investment's a long-term game. So it's not jumping at the next opportunity or panic selling at the first sign of a downturn. It's about staying the course, riding out the bumps and focusing on the big picture. But that's hard to do when the media's out there all the time telling you about the negatives, isn't it?
It certainly is, and particularly if you've got that short-term focus, Michael. You know, a lot of investors they want to get it right, they want to get the timing right. What are some of the reasons property investors shouldn't be scared off, Michael?
Well, I guess at the moment you've got to go back to the big picture. And if you look at what's happening, Australia's currently in the throes of a housing shortage, and the crisis is only going to intensify as our population is going to grow. The recent budget suggested our population could grow by 1.5 million in the next 3 years. Now, that's a combination of the immigration, it's the combination of natural population growth, and also the students and the temporary visas. That means we're going to have to build 5 Canberras in the next 3 years. We can't. The infrastructure's not going to cope. But
I can't see that happening, yeah.
Yeah, but that's going to create a strong demand for properties to rent. We know vacancies are low and to buy. So you asked, what should we do to avoid the media's negativity? Remember the big picture. Also, I think that one should remember the big picture that the property markets have bottomed. Now, that doesn't mean there won't be further falls in some locations. It doesn't mean there may not be some more interest rate rises. But I don't think now it's a short-term blip. I don't think we're in a speculative bubble. The fundamental shift is the supply and demand factors, and with the lack of supply coming on stream and increasing demand, I think that's one of the fundamentals we have to remember. And the other is, look, interest rates, there's going to be, until we've had a few months of no interest rate rises, there's going to be the media scaring us, telling us that interest rates are going to keep going up and it's going to make us fall into recession. We are, in many ways, feeling like we're in a recession at the moment. A lot of families are having difficulty making their budgets meet, and it's what some people call a per capita recession. Even though the economy in general is growing, it's because there's more people. So for each person, they're having a bit of a tougher time. But I think you've got to remember interest rates are near their peak, and all the banks are suggesting interest rates are going to fall sometime, probably next year. Not a lot. We're never going to go back to that 1%, 0.5% interest rate rise. That was wartime. We were at war. We were at war against COVID. We were at war against a worldwide pandemic that could have wiped us out. So we had to take wartime action. That won't happen again. But interest rates will fall 0.5%, 0.75%, maybe. We don't know. The Reserve Bank hasn't worked out yet what neutral is. In other words, not stimulating the economy like we needed to through COVID, but not bringing it down like it's currently doing. And currently interest rates are now recessionary. They're slowing us down. And we also have to recognise inflation's peaked, but it's not going to fall to that 2 to 3% band the Reserve Bank's looking for several years. The Reserve Bank said that. The forecasts are saying that. And while that might seem bad news, Brett, I think savvy investors know that real estate's one of the best hedges against inflation.
Yeah, look, and I'd also add to that, Michael, a lot of our listeners probably didn't have the benefit of attending our wealth retreat recently when Simon Kirstenmacher spoke about demographic trends. And I know you've spoken a lot about those big structural shifts are the ones that cause the booms. And he was mentioning that baby boomer generation handing over their wealth, from 30s to 40s. So we're not too far off that. And taking a longer term picture is certainly really, really important.
You're right. It really is demographics that drives our markets, how many of us there are, how we want to live, where we want to live. And I guess, as you said, when we're going to die and hand over a huge intergenerational level of wealth. And that won't be for a decade or so, but the future is looking very bright. Having said that, I want to make a forecast, a prediction, and I'm going on record to say that if history repeats itself, and it will, my suggestion is that of those who get into property investment, about half are going to sell up over the first 5 years. That's always been the case, Brett, and that's despite all the information, the podcasts, the blogs, the YouTube videos. Actually, I was going to say it's despite all the information. Maybe it's because there's so much wrong information.
Well, there is a lot of analysis paralysis, isn't there? And I guess there's so much data out there to justify people's decisions. And if you haven't got a process and a process in place and a framework and a model in place to follow, then you're probably ultimately going to make the wrong decision.
Sure. I think the other prediction I'm going to make is that 99% of investors are never going to get the financial freedom they're looking for. They're going to buy one or two properties, and we know that statistics from the tax department suggest that of the 2.3 million property investors in Australia, so there's 26 million Australians, 2.3 million property investors, about 23,000 own 6 or more properties. And you can't really develop financial independence with 1 or 2 properties. Now, it doesn't matter how many properties you own. You need to have a big asset base. But I guess the statistic I'm suggesting is that this hasn't changed in all the time I've been following it, despite all the extra information. So moving forward, most investors won't build a multi-million-dollar property portfolio. Having said that, when the results of our clients at Metropole were audited a while ago, we found that they were 7.3 times more likely to own 6 or more properties in their portfolio. They were more than 7% more likely to fall into that 1% of property investors. And that's because they made the right decisions, because they got the right advice. So what I'd like to ask you is, what advice are you and your team giving property investors at this stage of the cycle? Or more importantly, maybe what mistakes are you seeing people making? Have you seen people make, so that we can avoid doing it this time round and taking advantage? No get-rich-quick schemes. They were not in a property boom. There won't be for a while. But there are opportunities at the moment, Brett.
Yeah, there certainly are. And look, we're very well qualified to speak about this, Michael. We've been doing this for a long time, and we've seen what works and what doesn't work. And I've actually put together 12, common reasons I've seen that property investors fail. So the first one is that they treat property investing as a hobby. They don't treat it as a business. And I guess, first of all, Michael, property investing is different to probably creating wealth. And what we're talking about that most investors want to achieve is longer-term sustainable wealth. And to do that, you have to treat your portfolio like a business. So people like the excitement of buying a property. They like going to open homes and
don't they? Yeah,
absolutely, renovating properties, and they want that excitement, which is fine. But I've often heard you say, Michael, if you're looking for fun, go bungee jumping or trail boat riding.
Yeah, that's right.
So, in my opinion, the property investment side of things should actually be quite boring. Running a business, you've got to understand tax and structures and finance. And to be honest, Michael, I actually find that stuff quite boring myself.
I agree.
Enjoy the property side of things, but I know the right people to talk with and ask. The other thing to point out as well is, I think I was listening to a Mark Creedon podcast suggesting that, when a plane is flying to a destination, 90% of the time it's off track. It's not on track. So it's a pilot's job to bring it back on track. And if you're treating your portfolio like a business, you're having those regular check-ins. You can look at your cash flow management, your finance strategy, making all those types of things, and also tracking towards your longer-term goal to make you get there. I'd argue that the average property investor probably doesn't look that far ahead or treat their property like a business.
Well, I think what you said is right. Your property investment should be boring so that the rest of your life's exciting. It's a means to an end. And it actually isn't just an event. It's a process which starts with you educating yourself, with you getting the right advice, with building the right team around you, putting a strategy together. I bet that's actually one of your points anyway, so I won't steal your thunder there. And then reviewing it, as you said. But you actually got to review it, in my mind, with somebody independent, because people are just too involved, too subjective. You've sunk too much time and emotion in, so you're biased towards your outcomes, and you sometimes don't really see what's not working.
That's a really good point. And it gets to my next point, that people do not have a strategy. And I'd suggest that, I think you put it quite nicely there, investing in property, they see it as an event. It's actually not an event. It should be a process. It should be the outcome, the manifestation of the data and the statistics and the information that we all put together. Too many people actually do it the other way around. We've got people who are, I guess a lot of people maybe upgrade their home and turn their old home into an investment.
Well, actually, owning a property isn't a strategy either.
Well, that's exactly right. Yeah. And that doesn't mean it's a good investment property, like you said. Others, I guess, fall for short-term things. Maybe it's comfortable because they want to drive past it. I think I've heard that a couple of hundred times, Michael, yourself. Maybe they're getting sucked in and they need a tax break or a bit more cash flow, and they're focusing on that short-term focus and looking at maybe buying off the plan and getting sucked in by marketers and things like that as well. And they're the common mistakes that we see. it's not necessarily a reason to buy there. I know a lot of people talk to me about a university or a train line coming somewhere, and
A hospital. Oh, I don't want sick people as my tenants.
exactly. And I had a client the other day who was still waiting 5 years from a promised train line that was supposed to be delivered, and there's no, I guess, train coming in sight. So,
Well, interestingly, recently the train line in Melbourne that Dan Andrews promised going to the airport, multi-billion-dollar project, off the rails now, so to speak. We're not building a train line.
yeah, exactly. So, look, attaining wealth, as I spoke about, creating wealth, it doesn't just happen. It's not going to happen by just buying a property or two. It's a result of a well-executed plan, and successful investors really, really understand that. You've got to be able to focus your energies on the short term, the medium term, the longer term, and the average person doesn't have the ability to do that. But if you've got a team behind you, you've got someone monitoring and measuring and making sure you're charting the course, you're a greater chance of succeeding. So I guess what we do at Metropole, Michael, as we kind of know, it's a strategy that's, I guess, lasted the test of time, but we actually start out with the end in mind. I can talk to people about property all day long, but if I don't know where they're going, it's going to be very, very difficult to help them get there. But once we're actually able to establish their longer term financial goals, and most people want to get to a checkpoint for themselves, but it's also about creating and building wealth for the next generation as well. And I know you're often particularly proud of the fact that you look after your kids and your grandkids, and that's something I aspire to do as well, and many of investors aspire to do.
I think one of the things we've got to recognise also is that we're all playing different games. So therefore, when we put a strategic plan together for our clients at Metropole, what makes a good investment for me at my stage is different from somebody for you at your stage, even though you've already got a very substantial property portfolio and have been doing it for a number of decades. And that's what suits you is very different to what suits somebody who's at the beginning of their journey or a first home buyer. So therefore, there isn't a one-size-fits-all plan, and we're all playing different games. And I guess that's why there's a market, why some people are buying and some people are selling. But I think you've got to be careful not to take advice from somebody who's playing a different game to you. I mean, how can every apartment in that tower suit any investor that walks into that developer's showroom or the off-the-plan salesman's office or the project marketer's database where they say, I've got the ideal property for you? So part of the strategy changes over time as your needs and as your property portfolio matures.
Yeah, I think if someone starts the conversation, we've got an amazing opportunity for you right now, you're probably in the wrong place. It's about putting those things in place, understanding your financial goals, working out the timeline, seeing whether your goals are realistic or not, and then I guess mapping it out, charting a course, understanding the process and the progress for where you're working towards, and absolutely finding ways to maximize your wealth creation. So, your finance is really, really important. The structures you're buying are going to be important because of tax implications and things like that as well. There's a number of risks that people probably don't think of moving forward, investing in property. It's so much more than just the purchase. And I think once you understand that, you've got the right team behind you, your chances of success are greatly increased.
I think that's what confuses some people when they come to your team at Metropole, because they say, okay, just refer me to the buyer's agent. But that doesn't work with the plan because, as I said a moment ago, their game is different to somebody else's game. So therefore, we'd be quick and easy, and to be blunt, we could make money quicker if we just zoom people through the system and bought them something. And that's what buyer's agents do. But a buyer's agent isn't a strategist, and even though they sometimes call themselves that, they're only going to tell you about the properties in their location, not in other states or in their areas of expertise. So I believe a buyer's agent is an important part of the team, but their job is to implement the plan that you talked about. But I guess you've also got to get the right strategy.
Well, that's right. And I guess number 3 is the wrong strategy. So almost as bad as having no strategy is actually, following the wrong one. And we always say that real estate investing in properties are long term, but it's also a high growth, lower yield type of investment. I know a lot of people try to change that, don't they, Michael? They want to have that growth and also have the yield, have the best of both worlds. But in reality, in most cases, that can't happen.
I guess other people look at it as a tax deduction. Wrong. It may be a bit of cream on the top, but you not having the right strategy derails you. Again, this just comes back to the point we started with, that 99% of investors never build a substantial portfolio.
Yeah. Many of them do chase the cash flow. We see that a lot. They think by, increasing cash flow, they're going to get to their end goal. But it is the growth that's the game changer. As you always say, cash flow keeps you in the game, and I think cash flow is definitely beneficial.
Important.
It's not life-changing.
Yeah. You've got to be able to stay the distance, don't you? So you've got to manage your cash flow, but you don't invest for cash flow. But that's the reason most people start. They want more money, so they think, oh, I'll buy a property and it'll pay my school fees. I'll buy a property and it'll give me a holiday overseas. It doesn't work that way.
No, it doesn't. I guess the next thing is number 4 is changing strategy. And I guess we see this through the cycles, don't we, Michael? When things are going well for growth properties, it's all about capital growth. But when the growth stops and interest rates rise and expenses rise, it becomes all about cash flow. And people tend to, I guess, change their strategy with the tide. And I know in this type of situation, Michael, I'm often getting people who say things like, well, look, I've got a growth property. Maybe I'll balance it out with a cash flow property. But that's not really what they're looking for, is it?
No, I think we should actually be looking for what always worked over the long term rather than what's working now. Going back to having a big picture and a long-term focus.
Number 5, Michael, is unrealistic expectations. And I think, a lot of people are still probably living about a decade ago when it wasn't really about the serviceability. There was no serviceability. If you had equity, you could go and buy as many properties you like. They read these overnight success stories with people, buying 5 properties in 5 years, or as we say, 10 properties in 10 minutes, no money down, and all these types of attention-grabbing headlines. But in reality, successful property investing is a get-rich slow process, and we say that a lot. As Warren Buffett wisely says, wealth is the transfer of money from the impatient to the patient. So, Michael, you often talk about the 5 stages of the property investment journey. Can you maybe elaborate on those a bit more?
Sure. Well, I guess this gets to the point that people have got unrealistic expectations, and it goes right back to what we said, be careful who you listen to in the media, not just the media, but all those new self-styled gurus. You and I have been around long enough to see how many of them are no longer around. I used to play the game with Rob Belander, and now I do it with you at the end of each year, where we look back at the old magazines, API magazine and Your Investment Property magazine, that are sitting in our offices, and we say, where are they now? They've disappeared. Be careful whose advice you listen to, because it may sound exciting. That gets back to my point a moment ago. Don't just look at what worked now. But you asked me about the stages. I guess you have to, first of all, educate yourself, learn what property investment is all about. Then most people have to start by saving, and that's spending less than you earn, and trap that extra cash flow. And you don't get a lot in a savings account, but you've got to save the deposit to get into the market. The first time is the hardest, because if you get it right, after that, the capital growth and the rental growth will help you get the next deposit. So then you've actually got to go to investing those funds, and there's the asset accumulation stage, and it takes 15 to 20 years, 2 to 3 property cycles to build a sufficiently large asset base of income producing properties to then slowly lower your loan to value ratios. And once you've got a good asset accumulation, a good set of assets, and in general, that's residential real estate to start with, you can then at the right stage start adding cash flow properties. And by that, I don't mean secondary properties that give more cash flow, but commercial properties. And when you finish your investment journey and you're wanting to live off your portfolio at the end, you end up usually owning your own home with no debt, because you don't want debt in your golden years. You should own an asset portfolio of residential real estate that is washing its face, at least, if not bringing out some extra cash flow. So you've got to, at the end stage of your investment journey, lower your loan to value ratios. And you really, in today's world, need other cash flow assets, very different from when you and I first started investing and you could live off equity. So whether it's shares, whether it's managed funds, whether it's money in your superannuation fund, or commercial properties, but residential real estate, you need a very, very large portfolio to live off. So if you want a good life, and that's the reason why often you need a mixture of assets. But first up, asset growth, then cash flow. It's got to be done in the right order.
Absolutely. And that leads us to number 6, which is those cash flow concerns. And certainly at this time of the cycle, with interest rates rising, inflation's quite high, expenses are quite high, people do have a really strong need and desire for cash flow, I guess. But it's really important you stay the course. I obviously we put a lot of information into our plans, Michael, and Stuart Wemyss also wrote an exceptional, blog on this. But we looked at a number of different inputs around the cash flow and interest rates and all those types of things. The biggest thing that makes a difference with property investing is capital growth. So when we're putting plans together, the one thing we don't want to compromise on is the capital growth of the property. So we can change outcomes. We can put buffers in place, which we do every 12 months for our clients. We make sure they're set up and they're structured properly. We can reduce to interest only. There's ways we can control cash flow and deal with those concerns. But the last thing we want to do is compromise the capital growth of the property. And that is my number 6, is dealing with those cash flow concerns.
Well, you've got to have the cash flow to hold your property long enough to allow the power of compounding to kick in. So what you said a moment ago is right. A finance strategy isn't the lowest interest rate. It's actually having financial buffers to see you through the difficult times. So I often say that we don't only buy a client's property by getting the right finance strategy. It's actually buying them time to ride the cycle, Brett.
That's right. Well, we're halfway through. We're first 6. Now we've got the second 6. So number 7, Michael, this is a personal one for me. It's overconfidence. Do you remember that conversation we had 15 years ago?
Which one? You got me on the spot. I was probably being overly smart, was I?
No. Overconfidence, Michael. I'd just been through the Perth mining boom. I'd had a couple of properties in Perth. My properties were lower grade properties, but they'd done exceptionally well. They'd almost tripled in value. And I was pretty proud of myself. I was overconfident. And I sat with you and you told me to sell them.
Was I right?
Absolutely you were, because at that particular time, if you remember, the average house price in Perth was also level with the average house price in Sydney.
Yes, it was.
Sydney's gone on to almost triple in value, and Perth hasn't done a lot. So overconfidence is something I take personally, because I was in that situation and you politely persuaded me to move those on and reinvest the funds in a superior location. But as I'm also saying to clients at the moment, Michael, everyone's a property expert at the moment. The last 2 or 3 years has been exceptional. You could have bought anywhere. But again, it's that knowing the details and understanding that. So overconfidence was number 7.
Well, a lot of people bought their first investment property a couple of years ago during that once-in-a-generation property boom. And while the property cycle has moved on, it's not going to give double-digit growth anytime soon. And so for that reason, I agree with you that we've got to have the right expectations, don't we?
We certainly do. Number 8, we've kind of touched on, which is getting sidetracked by, third parties, people like the media, the 24/7 news cycle. We often joke that a lot of bank economists have predicted 8 out of the last 3 recessions. Looking at all those stories, we also had the crashes. Remember the media cliffs and the fiscal cliffs and the high unemployment. And, now we've kind of got the fixed interest rate cliff as well. So that's really important to, like you said, have a plan, deal with all these types of issues and take them on board, but stick to your longer term plan. So getting sidetracked, particularly in these types of environments, can be quite easy, can't it?
Definitely. So that's why if you have a plan, you know what you should do. You also know what you shouldn't do. And then it means you're less likely to get sidetracked by the media.
Number 9 is not recognising that there are multiple property markets, not just in Australia, but also within certain locations. And I actually spoke about this at Wealth Retreat, Michael, when we discussed actually your suburb of Brighton, where I've visited many times. Obviously, those areas by the water, even the suburb of Brighton is not the Melbourne market. Even the Brighton suburb is not a Brighton market, because there's different areas, there's different pockets within that, isn't there? So perhaps you can elaborate a little bit more about your neighbourhood.
Well, I guess it's important to recognise that the media keeps talking about the Australian property market. And when we do talk about what's happened each month with Australian median prices, that's very much skewed to Sydney and Melbourne, where the bulk of properties are and the bulk of value is. But that gives a bad understanding of what's really happening locally. And as you said, each state's got its own markets, but in fact, each state currently is at its own stage of the property cycle. So Sydney picked up earlier on this year, starting in February, but it was the top 25% of the properties in Sydney, the more affluent suburbs that have picked up. By the way, they're the ones that fell first too during the downturn 12 months earlier. And those lower socioeconomic areas, and it's not a judge of people, but those people in those areas are suffering more with the cost of living rises, with the cost of petrol rises, with wages going up 3.7% over the last year. That was all the big news recently, but inflation's gone up double that. So within the markets. There's houses, apartments, townhouses, units off the plan. There's inner suburb, outer suburb, regional areas. And as you said, even in my suburb, on one side of the street, there's what's called the Golden Mile, where more than 60% of people have no mortgages against their home. So the rising interest rates are interesting, but really don't affect the people there. And you cross the road and then there are people who've owned their properties 10, 15 years and they've still only got a 50% mortgage. And then there are newer apartment buildings and young families who moved into the area who end up feeling the hurt of interest rates a little bit. So within that area, within this one postcode, the suburbs performing very, very differently. And the figures that come out are irrelevant. That's why median price figures, which are after auction clearance rates, probably the most commonly reported property statistic, we pay very little attention to them in our research at Metropole. We've got to go much, much deeper into that.
We do, and you also talk about property being a science and an art. So certainly I know a lot of people that get stuck into the science, but they don't have that on-the-ground perspective. They don't know one side of the road from the other and what's happening in their local market each particular day. And particularly if you're buying interstate, that can be particularly difficult. So
now it's interesting because you mentioned about buying interstate. One of the guests at Wealth Retreat, one of the delegates was a property professional from Perth, and happy to mention his name, Jared Mann, who's got Investors Edge, a great property management company there. And he was telling me how a lot of the East Coast buyers agents are now buying in Perth, seeing it as a short-term cyclical upturn, but he is scared by the properties they're recommending because they don't fly there, they don't go out there. They get a local property manager to have a look at it, and they're buying not just sight unseen, but with poor advice, because property managers understand what a tenant likes, but they don't really have the understanding of what makes an investment grade property. But you've seen the same in Brisbane, the Melbourne and Sydney property buyers agents who go there, they don't even hop on a plane.
No, that's a big, big red flag as far as I'm concerned. If you don't know that local area and you don't know one side of the road from the other and the good, the bad, the ugly, you should probably not be buying there.
Definitely.
Number 10, investors probably don't recognise that I guess around 80% of the heavy lifting for a property's growth is the location. And that's, I guess, the reason why we keep calling the saying it location, location, location. I guess the most important thing we always see also, it's that capital growth is really, really important, but people do confuse that with physical growth as well. And I guess a lot of the property spruikers and people get into those kind of newer estate areas where probably we wouldn't recommend investing.
Yeah, but they call them growth corridors, and they are right. It is growing. You go there and you see another new estate and another new estate, but that's actually the enemy of capital growth.
It is, because there's an infinite supply of the new housing coming along. We want a cap on supply. And look, this was one of the areas I bought in, Michael, when I first started investing, and you so wisely talked me out of it. But, I guess I was lucky enough to be the first person in one of those pockets, those new estates. And, we got some good growth in the area. Then all of a sudden they bought out 2 or 3 years later, a stage 2 and a stage 3. And you saw all this physical growth with a train line and a hospital and a McDonald's, and everything was going great. But all of a sudden there's a stage 4 and 5 released. And who's going to want to buy my home when they can spend an extra 10 or 20 grand to put their own touches on their home? And all of a sudden I had trouble finding tenants because for an extra $10 a week, they could rent a new property up the road. So that's what we call physical growth. You're a long way out. There's an infinite supply of new estates coming on the market. Instead of looking for, those areas that we look at where there's a real scarcity of those types of properties, quality housing, you can't just knock over and build another 1,000 houses. And you've got those 4 big amenities. You've got those 4 big hubs, the CBD, you've got the airports that are expanding, universities. Hospitals are incredibly important, Michael, because most of our bigger hospitals aren't just hospitals. They're research facilities, dementia, mental health. They create hundreds and thousands of jobs, whereas the average hospital's probably got a couple of hundred. So it's really important to remember that. And I know one of the sayings we talk about is that the rich, they don't like to commute. They're willing to pay a premium to get into those areas and locations. Particularly during COVID, it reminded us of the importance of that kind of 20-minute neighbourhood where everyone's kind of in the same place, and we can get out for a walk in the park or a gym or a place of worship and things like that as well. And being in close proximity to restaurants and cafes and those types of things. Really important to have a look at good school catchments for children and colleges as well, because that's going to be particularly important as well. And that's really starting to become a major trend, isn't it?
Well, what's happening is our markets are fragmenting. During that once-in-a-generation property boom of 2020-21, you could buy anywhere. You could buy on a main road. You could buy in a secondary location. Regional Australian properties went up in value. But now there's a flight to quality. First of all, buyers are being very cautious, so they should be. And then there's also the factor that the wealthier people at the moment are the ones in the market. And as you said, they're wanting to buy in the gentrifying areas and in those areas of amenity. Lifestyle has changed. Yes, more of us are working from home, but it's a hybrid working from home. So regional areas are now finding higher vacancies, and CoreLogic recently came out with a report showing that values in regional areas are falling faster than now the capital cities are growing. So you're right. This point was location does 80% of the heavy lifting. And we've done a previous podcast on the different types of location. Not all land's created equal, and not all suburbs are the same either.
No, and Michael, I don't know about you, but I wouldn't see that changing over the next 20 or 30 years. I think that the bulk of jobs are still going to be created in those areas. There's going to be more demand. There's going to be less supply. That dynamic's not going to change. There's certainly going to be a lot more people moving to the regions and moving out. No one's disagreeing with that. But I think the big majority trends, and we stick with majority trends, are going to be in and around those eastern states' capital cities.
They will. And in the middle ring suburbs, the gentrification 10, 15, 20 years ago occurred in the inner ring where the old working class suburbs changed. But now as the millennials form families, they're going to want to live in homes, or if they can't afford a house, townhouses, or if they can't afford that, some will still move to family-friendly apartments. But the millennials are going to be driving the property market over the decade, just like the baby boomers did in previous cycles.
Thank you, Michael. Number 11 is not owning investment-grade properties. And even if we get the location right, so we talked about the 80%, that 20% of being the property itself, even if we get the location right, not all properties are investment-grade. So it's important to own a property that has, good owner-occupier appeal, is scarce in supply that we just spoke about. One thing I'm really focused on, and the average person should understand, is that you've got to have something with a high land-to-asset ratio. And that's okay buying an apartment as long as it's in a small boutique complex, not a complex of 2,000 or 3,000. We also look for something special, something with a twist. Maybe there's some, add value potential. If it's an apartment, maybe it's got a nice small courtyard or balcony or something like that. That's quite good. And obviously we talked about adding value, and also something that I guess in this day and age, Michael, that the banks are happy to lend to as well.
Oh, very much so. So not all properties are investment grade, and having the wrong property in the right locations just as bad as having the right property in the wrong location.
Definitely. And that brings us to number 12, Michael, and something that we've obviously taken advice on ourselves is actually doing it alone. Or
not doing it alone is, I guess, the advice we'd be giving people.
Yeah. And look, just because everyone lives in a property, or maybe they've bought a property and it's done okay, it doesn't really give you the qualification to, I guess, expand your wings and grow your property portfolio. So it's really important to have a team around you. And Michael, you and I both eat our own cooking. I know we've both purchased Interstate. We obviously know a fair bit about property, but at ground level, we don't know the art part of it. So we actually outsourced that to one of our buyer's agents. And as you said, buyer's agents are very important, and they did an exceptional job for both of us, didn't they?
They did. They very much have. So thank you for going through those 12 points. And maybe there's one I'd like to just go back to, and that's the importance, the need to have a plan, because as our property markets are going to give significant wealth for many Australians, as I said right at the beginning, statistics show that 50% of those who buy an investment sell up in the first 5 years, and those who stay in the game, 92%, never get past their first or second property. And I think you said it wisely, attaining wealth doesn't happen. It's related to having a plan. In other words, you're bringing your future into the present so you can do something about it. But let's make things clear, as I said before, just going off and doing the research or buying a property, that's not a strategy. So I like what you said. You start with the end game, understand what you need, what you want to achieve, and then you build a plan, a strategy to get there. And the property you eventually buy should be the physical manifestation of a whole lot of decisions that you make, and you've got to make in the right order, because property investment's a process. It's not an event. So for those listening to this, if you're a beginner looking for a time-tested strategy to take advantage of this cycle, or if you're an established investor and maybe you're a bit uncertain, or maybe you want a second opinion about your situation, I suggest you allow Brett's team at Metropole to build you a personalised, a customised strategic plan. Because, as we've said, when you've got that, you're much more likely to achieve financial freedom, because it'll actually help you. It'll help you define your goals. Actually, it'll see if they're realistic, because that's one of the points you made, Brett, that you may as well work out, is it realistic for your timelines? And for those who've got a portfolio, we actually look at the performance of it. Is it going to get you where you want to get to or not? And then we help you find ways of maximising your wealth through property. But I think just as importantly, defining risks you haven't thought of. So we help fix people's problems. We help them from falling into the landmines. We've been there. We know where not to step. And we help them grow their wealth. And I think that real benefit of having a strategic plan by the team at Metropole is it'll enable you to grow your wealth safely. So it's not just growing it faster. It is a shortcut. Shortcuts usually get you into trouble. Shortcuts usually involve risks. But if you've got a formula that's been proven, and the plan isn't just buy property, we have subparts of an asset accumulation strategy, a manufacturing capital growth strategy as part of the plan, a rental growth strategy, an asset protection and tax minimisation strategy. So a lot of our clients end up speaking with Ken Race and his team to make sure that they've got their structures right. We talked about the finance strategy, and then eventually how you live off your portfolio strategy. So if you're keen to take advantage of this stage of the cycle, go to metropole.com.au. I'll leave a link in the show notes, and Brett and his team would love to see you and help you take advantage of this new cycle. And let's not just even the odds, but stack the odds in your favour. Brett, thank you for that list of 12 things. It clearly shows that you've been around the block a few times. You've seen lots of clients. We've seen what works and what doesn't work. And I don't want to discourage people when I said that only 1% of investors end up with 6 or more properties, because there's two ways of looking at it. 99% of investors fail. I won't even bother. The way I would look at it is, hey, what did those 1% do? How can I copy them, emulate them, and do the same?
And I think that's exactly what we want to show people and show them the path to do that.
Perfect. Okay, thanks for your time. Look forward to catching up and having another regular chat with you.
Sounds good, Michael. Thank you.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to suggest that fulfillment and not happiness should be your goal. What am I on about? Well, look, happiness is transient. Psychologically, happiness is a temporary boost in the neurotransmitter dopamine. This dopamine boost gives you the feeling that we call happiness. But that boost is impossible to sustain beyond a few hours. Your brain eventually shuts down the production of dopamine and you revert back to your dopamine or your happiness base level. So if happiness is your goal, it's one you're always going to fail to achieve. Instead, I'm going to suggest fulfillment should be your goal. I guess fulfillment is the feeling associated with doing something that's meaningful, that's rewarding. When you're engaged in activities you're passionate about, that trigger that positive emotion in your brain every time you engage in that activity, that's what you should be aiming at. When your positive emotional brain's engaged in activities that you're passionate about, it gives you that feeling of fulfillment, and that lasts for as long as you're engaged in the activity. It could be months, it could be years, I guess it could be a lifetime. So my suggestion in my mindset message for you today is fulfillment should be your goal, not happiness. Find your passion and then engage in it every day. And that way, you'll find fulfillment. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports, my way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?